Welcome to the latest episode of Wealth Uncensored. Today, I want to talk about an income tax saving strategy for business owners called income splitting using trusts. Welcome to the Wealth Uncensored podcast, straight talk about everything that impacts your wealth. In each episode, I share what I've learned through my own experience and 2 decades of helping high net worth clients structure their affairs to minimize taxes and protect their assets for the next generation. I'll also feature special guests who are experts in their own field, sharing their knowledge and experience to help you protect what's yours. I'm your host, Jimmy Sexton. Let's dive into today's show. So, a typical business owner does this with their money. They earn money from their business. They then use the money that they receive from their business, the profits from their business, to support their family. Then they also use the money that they earn from their business to invest, and those investments make money, and they may use some of that income to support their family. Here's the problem with what most people do. You have all this money coming in from the income. You have all this money coming in from investments. It all gets put together into a pot, and then it's taxed. The more income you have, the higher your income tax rate is, the more tax you pay. It's a simple equation. More income into one pot, higher tax rate, more tax, and then with whatever you have left, you support your family. Well, there's a better strategy. The strategy, now, you can't use any kind of a trust like a living trust. You have to use a properly structured trust. But let's say you put your business and all of your investments, basically anything that generates income, into a properly structured trust. And the beneficiaries of the trust are, let's say, you and your family members. So your spouse and your bloodline descendants, your kids, grandkids, so on and so forth. Now, when income comes into the trust, if the income is not distributed out of the trust, is going to have to pay tax on that income. And trusts in the U.S. pay tax at compressed rates, meaning that you reach the highest tax rate of 37% at $12,000 or $14,000. Whereas as an individual, you don't reach that 37% rate until $630-something thousand. But the trust only pays tax on income it doesn't distribute. So a very simple example, trust receives all this income. Let's say it's $500,000 in income. It distributes all that income to you. Then the trust pays zero tax, and you pay tax on the $500,000 distribution that you received from the trust. So there's still only one level of tax. And basically, in that scenario, the tax would be the same as if you'd received all that income individually. But if you have the income come into a trust, the trustee can decide who to distribute the money to. This can include your kids, grandkids, other relatives, friends, whoever you want. And those people may be subject to tax at a lower tax rate. So let's say all the income comes into the trust, and let's say it's $500,000. Instead of distributing $500,000 to yourself and paying tax on all $500,000 and then supporting your family, why doesn't the trustee distribute that $500,000 amongst the beneficiaries? Maybe you have 3 kids. It distributes $50,000 to each one of those kids. Now, each one of those kids is paying tax on $50,000, and they can use that money to support themselves rather than you supporting them. They're paying tax at a lower tax rate because they just received $50,000. They didn't reach the highest tax rate. Now, you've received $350,000 distribution. So all $500,000 has been distributed out of the trust. So the trust isn't paying any taxes, but now you're only paying tax on $350,000. Each one of your kids is paying tax on $50,000 rather than you paying tax on all $500,000. If you support your parents or other relatives or friends or whatever, then you can use the trust to distribute income directly to them, and they can use that money to support themselves and pay tax on that money rather than you receiving all that money, paying the tax, and then supporting them. This is a great tax saving tool. It is something that is very much overlooked, is very simple to set up, and can save a ton of money by taking advantage of other people's lower tax rates. I hope you found this short video informational, but it's maybe a short video, but it's a valuable strategy. Hope to see you soon on a future episode. Thanks for listening.
Thank you for joining me on Wealth Uncensored, where we help you minimize taxes and protect your wealth for the next generation. If you like our show, be sure to subscribe and leave a review. And if you have any questions or suggestions for future episodes, we'd love to hear from you. You can email us at info@esquiregroup.com. And don't forget to visit Esquire Group's website for more information on how we can help you secure your wealth. I'll be dropping knowledge again next week. Don't forget to join us.